Okay, welcome back. It is kind of late, so I'm not gonna lie. I want to jump right the fuck into it, but I am excited. I'm fucking excited. Okay, so we're gonna be starting off on chapter 4, what to trade. Day traders can trade in many different markets, whether it be oranges or euros. There's a lot of echo in this room. It's kind of weird. Okay. Each market has its own unique characteristics and advantages and drawbacks. The echo in this room is gross. All right. Okay. All right. Day traders can trade in many different markets, whether it be oranges or euros. Each market has its own unique characteristics, advantages, and drawbacks that should be carefully considered before taking the dive. For instance, the large cap stocks that most day traders focus on will rarely lose their value. A trader will be able to sell them for something in the future. On the contrary, an option contract or futures contract loses all of its value when the respective agreement expires. Most markets are known as derivative markets, where traders buy and sell agreements whose value is derived from the value of an underlying asset. For example, stock options are derivatives that represent the right to buy or obligation to sell a particular underlying stock at a specified price and time. Their value is derived from the price or expectations of price change of the underlying stock, as well as the time remaining on the contract and other factors rather than intrinsic factors. For the day trader, the benefit of trading derivatives is leverage, which enables him to take on greater risk in exchange for greater returns. Looking back at the stock option example, the right to buy a stock is certainly less than the price of buying the stock outright, but the value of the contract will represent the change in the underlying stock price. The trade-off is that an option trader could lose his entire investment if the stock doesn't reach a certain price. In this section, we'll examine some of the most common markets, as well as the benefits and drawbacks of each that day traders might want to consider. Stocks. The stock market is perhaps the most widely known market, which makes it a popular choice for many day traders. In particular, those just getting started with day trading may want to stick to the familiar before branching out into more complex markets. Stock represents a percentage ownership in a publicly traded company, which it gives up in order to raise money to finance its growth. Since stocks tend to move higher over time due to corporations growing in value, the market consists of many long-term investors that buy and hold securities over a long period of time. The reliance on the stock market for household wealth growth means that it's highly regulated by the government and industry. A day trader taking advantage of stocks may focus on identifying the top movers on a given day and then buy and sell those securities based on their volatility. Most opportunities in the stock market are driven by a combination of fundamental events such as earnings releases or clinical trial results and technical analysis such as chart patterns or indicators. Some day traders will also focus on larger indexes using greater amount of leverage to profit. Advantages of day trading in the stock market include highly regulated. The stock market is regulated by a number of different organizations, including government organizations like the U.S. Securities and Exchange Commission, or SEC for short, and independent industry organizations like the Financial Industry Regulatory Authority, or FINRA. Highly liquid. The stock market is generally very liquid, meaning that traders can easily trade in and out of stocks, although there are many areas of the stock market where liquidity isn't as readily available, such as ADRs or OTC stocks. Upward bias. The stock market has increased in value over time, unlike many other asset classes, since corporation valuations have trended upward. In fact, the S&P 500 index has averaged a 12% annual return since its inception. Wow. Well studied. The stock market has been widely studied by academics, economists, and analysts, which means that day traders have access to a lot of tools and information that can be used to improve. All right. Where was I? Weird fucking noises over there. Okay. Where was I? Okay, so I'm going to reread this. The stock market has been widely studied by academics, economists, and analysts, which means that day traders have access to a lot of tools and information that can be used to improve trading performance. Disadvantages of day trading stocks include high requirements. Day traders must start with and maintain a minimum $25,000 balance if they are classified as pattern day traders, which is a sizable sum of money for many novice day traders just getting started. Low leverage. Day traders using margin accounts have access to 50% leverage under Regulation T. Regulate or Reg T, which is significantly less than many other markets that offer leverage up to 50 to 1 or greater. Futures. The futures market is perhaps the most widely traded market for professional day traders, given the increased leverage available compared to the stock market. However, novice day traders should tread carefully in this market, given the added risks that it entails. Futures contracts are derivatives specifying that an underlying asset will be bought or sold for a specific price on a specific date in the future. These assets may include equity indexes like the S&P 500, commodities like crude oil, or nearly any other type of asset. In general, the futures market consists of commercial hedgers trying to ensure they receive a certain price for their product, and speculators that try to profit from changes in the underlying assets. For instance, a farmer may be growing a large quantity of wheat in which to ensure that he receives a certain price for the harvest next year. The farmer may sell a futures contract to lock in that price to a speculator that believes wheat prices are heading higher. When the delivery date approaches, the speculator may sell his contract to a cereal manufacturer who will then take physical delivery of the wheat and realize a profit on the sale. Okay. The futures market also has its own set of industry jargon that novice traders should know. For instance, the tendency of the price of a futures contract to move toward the price of its underlying asset over time is known as convergence. I'll read that again. For the tendency of the price of a futures contract to move toward the price of its underlying asset over time is known as convergence. Okay. When a futures price is higher than the spot price of a commodity, the futures contract is said to be in contango, while a spot price higher than a futures price is known as backwardation. These terms may seem foreign when just getting started, but they will quickly become familiar over time. There are many advantages to trading futures. Greater leverage. The futures market provides a day trader with greater leverage, enabling them to put up very little margin. For instance, equity index futures involves as little as 10% of the contract's total value as margin. Low cost. The commissions paid on futures contracts are often smaller than the commissions paid on stocks and other assets. There's no restrictions. The futures market has fewer restrictions than the equities market, including lower minimum capital requirements. There are also some disadvantages to trading futures. There's no bias. Futures contracts are short-term investments that don't have the same upward bias as equities, which can make them more difficult to predict. Greater volatility. The futures market is much more volatile than the equity markets, given the higher amount of leverage, which makes it riskier for day traders. Options. For day traders often use the options market to increase leverage or hedge positions in the equities and other markets. However, options can be risky for novice day traders with the potential of losing their entire investment. Options are derivative contracts that provide the right to buy or sell an underlying asset at a specific price and time in the future. When buying options, traders are purchasing the right to an underlying asset. When selling or writing options, traders are selling the rights to the underlying asset. Naked positions occur when a trader sells the right to an underlying asset without actually owning that asset. Many options are considered high risk because they are significantly more volatile than the underlying asset and almost always have less liquidity. As an options contract approaches expiration, it may also be at high risk of complete loss. For example, a contract to buy a stock at $10 that expires at the end of the day could be worthless if the underlying stock doesn't rise above $10 per share, but could be worth a lot if it does so. Advantages of trading options include leverage. Options provides day traders with greater leverage since they represent the right to an underlying asset instead of the assets themselves. Protection. Options Options enables day traders to hedge existing positions to reduce the risk to their portfolios at any given point in time. Disadvantages of trading options include lack of liquidity. Many options have significantly less liquidity than the equities underlying them, which can make it difficult to buy and sell the assets. Risk of complete loss. Options can expire and become completely worthless if an underlying asset doesn't reach the desired price before a specified time. Currencies. The foreign exchange market, also known as the currency or forex market, is the largest and most liquid market in the world. The amount of money running through the forex market every day has been estimated to be between 2 trillion and 4 trillion. Holy shit. Okay. Currencies. Okay. Yeah. 2 trillion and 4 trillion. Yeah, okay. Day traders may also appreciate that the market is open 24 hours a day, 6 days a week. I actually did not know that about currencies. Wow. What a beautiful world. I mean, seriously, like, stocks, futures, options, currencies, crypto, bonds. Oh my God, CFDs. Wow, they're gonna really jump. Oh my God. I'm excited. Okay, yeah, all right. Okay, let's continue. Okay, trading currencies involves simultaneously buying one currency and selling another in so-called currency pairs. The most widely traded currency pair is the Euro-US dollar, or EUR/USD. Purchasing the Euro-USD currency pair involves using US dollars to purchase euros and then profiting when they are converted back. If the euro appreciated in value, the trader would be able to repurchase the same amount of euros for fewer US dollars. Okay, it wasn't that complicated. Day traders active in the currency markets use a significant amount of leverage in order to profit from such small daily price movements. In the absence of fundamental changes or changes in the perception of national economies, the market is largely driven by technical analysis and the activities of very large institutional traders. The combination of high leverage and a lack of regulations makes the industry relatively risky for smaller retail day traders, since margin is a double-edged sword and loose regulations provide very little retail protection. Advantages of trading currencies include liquidity. The forex market is the largest and most liquid market in the world, which means that traders will never have any trouble entering and exiting trades. My mouth it's watering. Leverage. The forex market isn't very highly regulated, and high leverage is available for traders that dare to use it, which means profit potential is enormous. No commissions. Forex brokers generate their cut from the spread rather than by charging outright commissions on each trade. Disadvantages of trading currencies include lack of regulation. The forex market lacks many of the regulatory controls enjoyed by the equity markets, which means that traders face greater risk. Volatility. The forex market is characterized by high levels of volatility, which makes it much more risky than many other asset classes. Bonds. The bond market is not nearly as popular as equities or futures among day traders, but as other markets become more competitive, it has become increasingly attractive. Bonds are asset-backed or tax-backed debt instruments issued by governments or corporations that may or may not involve interest payments. So bonds are asset-backed or tax-backed debt instruments issued by governments or corporations that may or may not involve interest payments. Okay. Since prevailing interest rates and risk factors are constantly changing, the price of bonds tends to fluctuate over time. Some bonds, such as junk bonds, are exceptionally volatile given their already high risk profile, creating an opportunity to realize high yields even when compared to equities. Advantages of trading bonds include macro trades. Trading in government bonds like treasuries is essentially a bet on interest rates, which makes them great for short-term macroeconomic bets. Alternative asset class. Bonds are relatively uncorrelated with equities, making them a great alternative when equities are difficult to trade. Diversification helps reduce non-systemic risks by shielding an entire portfolio from losses associated with a single asset class. Disadvantages of trading bonds include less liquidity. Corporate bonds don't have nearly as much liquidity as equities, which can make them difficult to buy and sell on short notice, and there's less leverage. Day traders have less access to leverage in the bond market compared to other markets like currencies, futures, or equities. All right, contracts for difference, or CFDs, is great for betting on the solvency of a government or corporation. The day traders often use CFD as a hedge for other assets, especially during difficult times. Contracts for difference are agreements between two parties to exchange the difference between the opening and closing price for a specified asset. In essence, CFDs enable day traders to bet on a price movement without actually purchasing the underlying asset. For example, a day trader may believe shares of ACME company are going to fall from 100 to 95. A CFD would enable the trader to put up just 20% of the $100 or $20 and realize the same $5 gain, which represents a 25% gain instead of a 5% gain by purchasing the stock. Advantages of trading CFDs include simple. CFDs are relatively straightforward derivatives that enable day traders to leverage their exposure to a given asset. Leverage. CFDs offer a high level of leverage compared to many other asset types, with the ability to only put 10% or 20% down. Disadvantages of trading CFDs include higher risk. CFDs involve a higher level of risk compared to traditional assets, since the day trader can realize a complete loss in a short period of time due to the use of leverage. After all, leverage is a double-edged sword that amplifies both gains and losses. Counterparty risk. The CFD market is not very regulated. Quick recap. There are many different types of assets for day traders to consider, but it's important to understand the mechanics, benefits, and drawbacks of those assets. Different assets have different risk profiles and startup requirements. Stocks represent the most popular class of assets, and many day traders, because of their high liquidity, tight regulation, and upward bias. In general, most day traders begin their careers in the stock market and then move into other markets later on. Commodities represent the second most popular class of assets for day traders because their high liquidity and significant volatility due to weather patterns, seasonality, and other factors. Day traders looking for greater volatility will look towards these markets for opportunity. Currencies represent the single largest and most liquid market in the world, with trillions of dollars exchanging hands every day. While the market has limited oversight, it's becoming increasingly popular for many day traders. Bonds represent a small and growing portion of the retail day trading market that is driven by those taking advantage of government bonds. With increased volatility in recent years, the market is becoming increasingly popular among day traders. CFDs are a relatively new type of derivative in the financial market. They provide a unique risk-reward profile compared to traditional assets. Most day traders stay away from this asset class due to its lack of regulation and higher risk. Okay. And that concludes chapter 4. That's pretty good. I learned a couple things that I wasn't aware of. So, good shit. Thanks for joining.